Welcome everybody on here to Hampshire Capital, our Hampshire Capital Diversified Real Estate Fund 1. Happy to have you joining us today. We've got Brendan here in the house. It's going to be my co-MC and taking care of the chat function here. He'll put some information here in the chat. And I want you guys to stick around because we've got a special Q&A here towards the end. So as you're going through this, put your questions in the chat. If we can't answer them there, we will definitely answer them towards the back end of this. I'm excited to have you here today. We're getting close to the holidays. It's always impressive to me to see people still commit and join when we're so close to the holidays. So first and foremost, thank you, and we're going to go ahead and get started. All right. Shane Carter, take us away, man.
All right. Thanks, Eddie. Appreciate it. Glad to have everybody join us here today. So my name's Shane Carter. I am Principal and CEO of Hampshire Capital. And I've been doing this for quite some time, a little over 25 years now. Done more over 350 million in multifamily commercial transactions, another 120 plus or so in construction development. And I'm honored to be the lead of this team of amazing people, especially in terms of the culture of our organization and who we are and how we conduct ourselves. And so, Nick, with that, I'll pass it over to you.
Yeah, thank you, Shane. Good afternoon, everybody. Eddie, thank you for emceeing as always and setting the tone here. My name's Nick Bouquet, Shane's business partner, principal at Hampshire Capital, and CEO of the company. Been involved in multifamily and commercial real estate for a bit over 15 years now. I transacted on over $500 million in multifamily, and primarily here at Hampshire, I'm in the COO role. I'm overseeing kind of all aspects of operations with the team here on the call and overseeing their various day-to-day activities and operations and goals. And then I also head up all of our underwriting and analysis on all new investment opportunities.
Thanks, Nick. Eddie Austin here, be your MC today, taking you through this exciting pitch deck. Been in real estate since about 2004, managed a portfolio of construction, a little over 180 million. Construction nationwide, from subdivisions to housing to industrial, commercial, solar, ground up development. Take care of the vertical integration of our construction arm. Excited to introduce you to our next person, will be Brendan.
Thanks, Eddie. Appreciate it. Yeah, my name is Brendan. I come from the family office space, and I have experience working through all strategies throughout the capital stack. And I lead investor relations here at Hampshire Capital. So if you guys ever have any questions on any of our opportunities, including this fund, I'm happy to answer you. And if you guys want to do any questions throughout the course of the webinar, just feel free to put it in the Q&A box on the bottom right of your screen, and I'll be sure to answer it as we go. But I want to make sure that you all hear from me as well and get the opportunity to do a one-on-one call. So I'll be sending an email to you after as well, just kind of hearing about what you guys thought of the webinar. And I'd love to give a chance to all of you to speak to me directly and make it a little bit more personal and get to know you. So I'll be active in the chat and also put my email there as well.
Thanks, Brendan.
Thanks, Eddie. And again, good afternoon to all the guests joining us. My name is Mo LaPointe, VP of Land Acquisitions. Been involved in multiple commercial real estate transactions over the last several years. Definitely proud to work alongside a passionate team of professionals here at Hampshire Capital. For me personally, I'm currently focused on delivering value creation through our land development positions nationally. And again, excited to have everyone here to learn more about our projects.
Thank you. Michael Payne, take it away, bud.
Thank you very much. Thank you, everyone, for being here as well. My name is Michael Payne. I'm the Vice President of Asset Management. I've been in this field of real estate for multifamily and some land for the last 20 years. I've been involved from the operations side, the asset management side, budget, renovations, you name it. Have managed over 7,000 apartment units portfolio-wise with over $1 billion in value. As you can tell, I am your geek of the group. Nick is definitely probably geekier than me. But from that standpoint, I am an Excel lover and a former actuary. So I'm the guy trying to make sure that as we do the deals on the backside, that we can make the goals that we've set for these investments happen in the right way.
Absolutely. Absolutely. So what makes Hampshire Capital unique? And I want to first say we're investors. We're investors in this every day. This is where we come from. We cut our teeth on developing land, buying multifamily, renovating multifamily. So we understand. We understand what it takes to run these properties. We understand the risk mitigation of this, the cash flow and the total return, including the tax mitigation, the things we need to do in our the case studies that we do alongside with bonus depreciation by going through that with third party to understand all the things we can do to capture that depreciation and through cost segregation. And we're definitely a neighborhood first mission. I know Michael and I both have spent a lot of time on our properties making sure that we have a prioritized positive impact with the residents that we serve. It's a cornerstone for a long-term growth. We want to make not only the neighborhood happy, but the people that live there. We want to make sure that everybody feels good about what we are offering and also that they're proud to be on that property. They feel good. We go in and we replace the signs, we rebrand everything, and it really makes an impact in the public eye. And we're proud of that. I say we're a team of experts, we're a team of professionals here. At the highest level, we're always integrating, we're always learning. Michael and Nick are always digging in the data, looking at the macroeconomics. And Michael is taking that data and giving feedback on what we do in our properties and how that speaks to the data that we're receiving. So, we're dedicated, full cycle experience here in commercial real estate and alternative assets and an investor service, and we are an educator. Talk a little bit of our track record here. Between us and our principals here on the call, we got about 70 years collective experience acquiring and renovating, operating multifamily apartment buildings, commercial properties, and land development. Since the company's been founded, we've transacted around 5,600 units and $550 million in multifamily transactions, about 320 land deals, and about $125 million in value. So common investing fears, we like to think about all the ways that we're identifying all of these in the public eye. We get these questions all the time. Here's kind of the summary of that. So investors' questions, what do we hear from investors? The number one thing I hear all the time is 2024 the right time to be investing in real estate? Well, I'm going to be honest. We have definitely underwrote a bunch of deals, multifamily deals and some other deals in 2024. We hadn't bought anything because we couldn't find anything that really fit our criteria. And we're pretty savvy when it comes to really digging in on these things. I would always recommend that if you can find a deal that pencils out, and if it makes dollars, it makes sense to move forward. So I always say the best time to buy real estate was yesterday. Next best time is today and making that investment. And then why should I invest in a fund versus individual properties? Man, this is my area of expertise here. I'm a fund manager. We morph to the funds instead of the syndications. Look, I'm going to be completely honest. I'm going to put out the pain points here. To think about investing in a syndication over a fund, me personally, I wouldn't do it. If you're putting all your eggs in one basket and you're putting everything in on one single address, one opportunity, everything's got to be right. And just a little scenario here, if we're going to go out and buy 5,000 units, say we split that up in maybe 14, 15 different syndications. If we're going to make it to that point, buying 350 unit assets per asset type and per tranche that we purchase something, that means 14 or 15 times we got to do it perfectly. Doesn't always work that way. That's why we highly recommend a fund, because all of those assets we'd buy and probably 3 or 4 funds to achieve 5,000 assets would be diversified across the entire portfolio. The next question we get is, what should I ask a fund manager before investing? Number 1 would be track record. Number 2, I would always recommend, what are you, your sponsors, actually investing into the deal? Are you putting skin in the game? Always a good question to ask, because if they're putting money in along beside you, that means they're truly a partner and they're taking the same amount of risk as you are. So our executive summary here, Nick, if you'll take us away on this.
Sure, glad to, Eddie. So Hampshire Fund 1, it's a 3 asset class fund, all of which are focused around residential. So it's a sort of the residential niche, but we've diversified it with 3 different aspects of residential investing. And that's a combination of multifamily, outdoor hospitality, and land development. And we specifically picked these 3 types of residential investments by design. Multifamily to provide stable cash flow and serve as the kind of the core foundation of the fund. It's the primary asset class within the fund, makes up about 50% or more of the fund. Outdoor hospitality is an emerging asset class that generates higher cash yields. So that provides cash flow above and beyond what we would typically see in the multifamily investments to provide more cash flow for the fund and for the fund. And then land development is a total return strategy that is a no cash flow, but provides high total returns beyond what we would typically see in multifamily or outdoor hospitality. And so it's a $50 million fund. We're offering a 10% preferred return. Depending on the size of the investment, the average annual return is expected to range between 20 and 28%. And we have about a 5 to 7 year hold period that we're projecting here. Most importantly, we've designed this fund with no fund level fees to provide the most returns possible for the investors and really to create that alignment of interest between Hampshire Capital and our investors in the fund.
Absolutely. Thanks, Nick. So a little bit more about our fund structure here. Again, no fund level fees, not charging anything at all. You know, this is another thing I would tell people that's wanting to invest is when you're looking through the documents, really pay attention to the fees that these people are charging. They can be very fee heavy. Very common model is 2 and 20, meaning that the first 20% goes to the investors, the next 2% goes to the fund managers. We're not even doing that in this fund. So we really enhance in returns here without fees. And then another thing is we've done something here to enhance returns for larger investment. So we got 4 tranches here to look at. We're going to look at the example of A1, a 5-year projection, and that's a 17.2% IRR and a 20% average annualized with a 2x multiple. If you look down here at the A4, you'll notice that the preferred return stays the same. It's a 10% pref, but you can see the promote split starts to change by invested capital. And then the rest of the numbers change from the IRR to the equity multiple. You know, anything's 5 million plus, you can see that we actually jump up to a 28% average annualized return. So Nick, go a little bit deeper here on the different ones that we have and how we allocate our funds to different types of assets.
Yeah, sure. So this is a visual example of what I was describing on the 2 slides ago around how we're balancing a multifamily or blending multifamily, outdoor hospitality, land development. So, you know, the multifamily is the largest portion of the fund to provide that stable base for the returns for the fund. But then we're adding in the outdoor hospitality and land development to provide cash yields and total return kind of beyond what you would typically see in a pure multifamily fund. You know, this is all the way the allocations and the way we've balanced and designed this is really to provide a balance of stability with higher return possibilities. And, you know, we're investing across strong geographic markets, primarily in the Sun Belt, where we have existing experience and investments and where we're seeing kind of that long-term strong trends and macro growth that we want to support, that, you know, that is in place to really support the fundamentals of all 3 of these asset classes. And on the fund itself, again, is the intent to provide efficient use of investors' time by providing them with the exposure to multiple asset classes and multiple investments within each of those different asset classes. And then, you know, the fund also provides that tax efficiency benefit that Eddie mentioned earlier.
Absolutely. So Shane, take us away, buddy. Talk about the Hampshire Capital investment framework and our discipline approach.
Yeah, thanks, Eddie. Appreciate it. So look, everything we do is data driven. We approach things with a very clear understanding of how we're going to proceed relative to each investment. And you know, that goes from the macroeconomics all the way down to the neighborhood level data. You can buy a great deal in a horrible neighborhood and it won't do well. And you can buy, you know, a so-so deal in a great neighborhood and it'll outperform because you're buying in the right area. You're sort of in the right stream, as we call it, and you're heading in the right macro direction with your investment. So understanding that data and drilling it down to the neighborhood level is absolutely critical in investment selection. And that's something that we pride ourselves on. We're very diligent about, and we don't yield off of those metrics, and we don't yield off of that thought process, regardless of how good or how compelling some one-off opportunity might look. We just simply won't look at it. So we're very, very diligent in how we approach our investment thought process. Alignment with best-in-class partners and operators. So all of our deals to date have been in partnership with large institutional capital. We raise and contribute a small amount of capital, and the vast majority of the capital, up to 90% of the equity in some of our deals, is provided via institutional capital partners. We feel like that is a hallmark of who we are and provides our investors and ourselves additional security because we have very large money, very smart money, vetting not only who we are, but also vetting every opportunity to ensure that it aligns with their fund and their investment objectives. And the fact that they say yes to us and proceed forward and write us checks that have ranged anywhere from $6 million to $30 million in equity size is, I think, a great thing for us to share with our potential investors, that we have that in our Rolodex here of folks who invest in us. And so risk mitigation is critical. I'm an investor. We're all investors. The general partners are investors in the fund, and prioritizing the preservation of our capital is paramount. We've never lost an investor dollar, never intend to. And that's got to be the paramount thought process in everything that we do. Then getting enhanced yields and great risk-adjusted returns from there is a great secondary goal. Again, diversification that Nick and Eddie talked about, blending that stable yield with high growth investments, we feel is a very compelling and interesting blended return profile for a fund, and that's why we selected it this way. I believe in it, and I'm investing in it personally as well. Active management. Everything we do is fully hands-on. There's nothing that we do that we're a capital allocator and we're just investing in someone else's deals. It's not what we do. That's not what our fund does. We are extremely diligent, active, hands-on. Michael Payne is in the weeds on a daily basis, ensuring that every single asset is performing as well as it possibly can. We don't just rely upon our best-in-class third-party property management firms to do their best job. We inspect what we expect. We follow up with them diligently. We have our own KPI metrics that we're measuring and guiding ourselves against, and we're managing the managers very, very actively. And that's what sets us apart from a lot of operators. And then, like Eddie talked about earlier, we have a people-first philosophy. It's just important to who we are and how we conduct ourselves in business. Putting the experience of the residents in front of our own, drives for growth and for profitability is a very wise way to approach this business. And I feel like not enough people do this. The health and vitality and experience of your resident actually equates to better performance in the investment. And I think so many sponsors miss that critical step. And so that's paramount. That's key to our philosophy and how we think about every investment is someone else's home. And if it was my grandmother living there, what would I want her experience to be? And that needs to guide every decision we make about how we run every property.
Absolutely.
And also, of course, with regards to our investors, because we're also investors. So putting ourselves in our investors' shoes and making sure that that experience and that the thought process about our investors comes in front of how we operate as a business.
Absolutely. Michael, go into a little bit more detail on, what we do with our residents, like our resident events and stuff like that. So what are the things that we really do to really drive this home?
Sure. Some of the things we do, we're constantly at, for example, our multifamily communities, having weekly events. So in a month, we'll have usually around 5 events, and they can range from anything from like offering a cocoa bar and setting up, candy canes. And then the team on site is sitting there helping residents and making different things, having little design things where the kids can come in and design little ornaments or make things there on site. It's the involvement with the community is to get them to know each other better, the people that are living next to each other, the neighbors, and saying, hey, you know what? We're building trust with this on-site team as well as the neighbors that are around us. It makes it a lot more difficult for them to want to move, and they're really good about talking to us. You'd be surprised at how many residents, don't want to talk to the office and don't want to interact. And therefore, we don't get data. We don't get any type of feedback on how to make their experience better. So our whole goal is to get as much interaction with you can. And if you think about it, it's almost counterintuitive to what our world is doing today. Today, everything is becoming so automated that people are less and less wanting to have interaction. And what we've found is that when we get that interaction from our residents, not only from us actively managing and making sure their work orders are getting done timely and things like that, but it's also the more that we make them kind of go, hey, I kind of like living here with the individuals that live here. I don't want to leave if I'm getting a rental increase that's aligned with the market and saying we need to go up some to cover additional bills or to pay our investors. We don't get as much pushback. So it's all about creating that type of an environment, that type of feel when you're on site. And it's also taking that look at who's living there. What are their challenges? What's going on? I've managed a property. I've been a regional at properties. You name it. I've worked work orders at properties at different times in my career. And from that standpoint, you really get to understand what are your residents, what are your people that are there thinking like, so that you can offer the best feeling for them to have a community to be happy to live at.
Absolutely. And anybody that knows me well knows I'm a business guy, and I like to check the data that we're actually talking about. And one of the ways that you can measure that is by your Google reviews. And kind of in multifamily value add space, your gold standard is about 3.6. If you're above a 3.0, you're doing some good, especially in a value add property, especially in today's age. And all of our properties are above a 3, they're either at a 3.0 or above that. And I'm extremely proud of that, to know that what we're doing is actually being checked by the Google side of the business. Nick, take us away on the market observation here. I know you do a ton of work in this area. This is definitely your slide.
Sure. Glad to do it, Eddie. So I'm going to start with multifamily since it is the sort of largest tranche of the fund. Multifamily kind of in a macro sense over the last 18 to 24 months has really had a lot of challenges. Some of them are capital markets related around rising interest rates. Some of them are more market-related challenges. We've had an unprecedented amount of supply coming into these Sunbelt markets over the last, really over the last 12 months, and probably, really for the next 12 months as well. We're kind of in the middle of that massive supply delivery. Just for context, Dallas historically has delivered roughly 25 or 30,000 units on average per year, and we're more like 45 to 50,000 at the moment. Really, in a market like that is fundamentally growing and has incredible demand, we've seen unprecedented amount of supply coming into a lot of these markets, and it will all get absorbed. And the good news is, on the sort of tail of that, there's less new product being started today, so we should have a supply imbalance in a positive way. 24 starting kind of 24 months from now. But in the meantime, it has put tremendous pressure on these Sunbelt markets, which has put downward pressure on occupancy, downward pressure on rents. But really, maybe even more concerning than all of that is kind of what we're seeing at the tenant level. And this goes back to Michael and I talking regularly, and kind of what he's seeing at the leasing level. There's been a lot of, the residents are kind of unable to pay what they used to pay, right? And that could be recessionary things, job market things. We're seeing kind of negative tenant behavior in that regard as well. And so we put all that together, and we've had this, and that's created this sort of near-term challenge in, not only operating assets, but also really just finding assets to acquire that have a good story and the ability for us to create value. We're just having a hard time seeing that in the data. We're tracking it. We are absolutely tracking it closely at both the market level and the neighborhood level on a month-by-month basis. And we're starting to see the data maybe start to bottom and show us that maybe we're going to we're starting to get in the other side of some of these issues. But until we see the data turn upward and we have a positive trend that we can get behind from an investment thesis perspective, we just don't feel like it makes a ton of sense to invest in multi, certainly in 24. We do expect that to change in 25, probably starting around Q2. But if the data suggests that it's starting to move earlier, we'll be jumping in back earlier. And, all of the downward effects I just described, pricing has absolutely come down on multifamily assets. We still have a gap between where we would want to buy something and what a seller was willing to sell something for. I say it to these guys all the time, just because something looks cheap doesn't mean it's a good deal. We're seeing values come down, but we're still not seeing the ability to create value even at that lower cost basis. And that's really what we're always looking for. Is every property, every investment has a business plan. It has to have a thesis. We have to feel 110% confident that we're buying something where we can create value. Shane mentioned before, kind of being in the right stream. Until the stream of multifamily starts to move in the way that we want it to move, we're just going to be patient, sit tight, continue to look at deals and track data. But, again, it's something we see the fund jumping into in 25, but so far in 24, we haven't seemed to be able to make sense of the opportunities we're seeing come across the desk. So, but On a long-term basis, absolutely strong long-term fundamentals. Again, we think starting to buy things again in 25 will be very well positioned for rent growth and occupancy improvements kind of going into 26 and 27. But again, we're really looking to wait to see that data turn. On the land development side and RV outdoor hospitality, those investment classes have been doing very well in 24 and will continue to be very well positioned into 25. We're going to walk through a land development deal today on the call. Another 4, 5, 6 in the pipeline that are very real and very actionable in Q1 and Q2. Fantastic demand of fundamentals, and we don't see that changing in 25, and frankly, only probably getting better into 25 and 26. So we're very excited about that. The opportunities we're seeing there.
Awesome. Thanks, Nick.
Hey, Eddie, can I add one thing real quick?
Absolutely.
To Nick's point, and this is what I love about our group, since we're investors as well, we're not out taking anybody's money and putting it in something we wouldn't put our own in. So we're looking at these things from the standpoint of not only ourselves, but our investors, and they're parallel with each other. So we really do not want to see money go into a place that maybe has a little bit more downside for a little bit better of a return later. And that's how we're going to make sure that we focus. If it's multifamily right now, that's maybe not looking quite as good until maybe 6 months later from now, great. But land development and RV outdoor hospitality, they have those opportunities. And that's where we'll be focusing to make sure that we're maximizing money if those fundamentals are strong. So I just wanted to throw that point out because it is important to know that, yes, we have these things on our list of items that are in our fund, but we're not out just buying them because we listed them on the fund name.
Yeah, 100%. And I would add one more thing. There's definitely a lot of pain points around multifamily when it comes to limited partnerships and general partnerships, code VPs, and even joint ventures. There's definitely been lots of things in the news about multifamily, and we definitely pay attention to that. And we're not wanting to be a part of that at any cost. And we really pay attention to every single thing that we do to make sure that we check all the boxes, because we don't want to be on the real deal with the rest of these guys that didn't do as good a job as vetting the process like we do. All right. So if there's anybody in the room that's the land rock star, we've definitely been a part of land development together. But there's one guy that really loves the land for sure, and that's Shane Carter. So take it away.
Thanks, Eddie. Yes, I do love land. I've been doing it for most of my career, and I'm absolutely, it's very enthralling to me because it's the process of creation. It's the process of taking raw land and creating communities, which eventually become homes for people. And it's absolutely amazing. And let's add that it is the tip of the spear. It is the first part of the process that creates the housing that we are so desperately short on all over this great country of ours, but particularly acute in the South, where we do focus a lot of our operations. So number one, look, from a capitalist perspective, you get great total returns out of this as well. We've seen project level returns that are 30, 40, 50% annualized in a very short, 24 to 36 month timeline horizon. You simply can't get that anywhere else. It's absolutely an amazing asset class for that type of investment. Super high barriers to entry. It's sort of a wealthy person's game, if you will. You kind of have to have money. It takes money to make money, so to speak, in land development. So there's not a lot of people that get into it. It has a tremendous amount of perceived risk. And frankly, it has a tremendous amount of actual risk if it's not managed well. And if you don't know what you're doing, and if you don't understand how to mitigate that risk and how to ensure that you have project feasibility and viability upfront, and that your exit strategy is sound, which we'll talk about here at the end. Of course, the fundamentals could not be better. We are at a severe housing shortage. The affordability gap has never been larger. And contrary to, I think, what a lot of, or some, I would say, folks think, rent control is not the answer. Production's the answer. It's supply and demand. You want lower pricing, you got to produce more. You need more supply. It's as simple as that. And so that's what we focus on. We're focusing on helping solve our country's problem of affordable housing and housing supply, which are, to me, are intimately tied. Two peas in a pod, those are, by being at the forefront of development and what it takes to get projects out of the ground, approved, and out of the ground, and actual housing being built. So the diminished risk profile is the fact that, for 25 plus years, we've been doing this and we have a great track record in doing it. And we've been able to identify and mitigate all of the risks in the process. And we focus on that before we take in investor monies. And I think there's some other slides that I'll save the most of that spiel for, because it's very important in terms of how we mitigate risk.
Absolutely. Man, if everybody's ready, I'm excited for this next slide. We're going to really dive into this. So if everybody else is ready, we're going to go ahead and jump in. So this is a investment that we found off market. Its opportunity was sourced by Hampshire Capital. It's 318 residential lots, single family development, and it's horizontal land development. So, and it's located in Versailles, Kentucky. I was down there this week and I was super excited to see the amount of growth that's in this area. And it is just a booming place. And this land is positioned so close to so many key roads that are coming in that will just continue to grow. I know oftentimes in my town, traveling to and from big cities, you always see this outlying land that's just outside of there. And you think, man, I wish that I would have known that the place was going to grow that direction. And I always kick myself for not thinking about buying that piece of land and tying it up somehow, some way. Because I think about the amount of money and returns that those investors were getting because they invested in that opportunity. And now there's this whole micro sub-city that has grown over the top of this farmland. And when I was down there looking at this, that's exactly the feeling I got. I was like, we finally have the opportunity to be right here. And I know one of these days, 5 to 10 years from now, it'll be overgrown by concrete. And it's just a key location. So that's what this is. Shane, take us through the rest of the way that we mitigate this risk.
Sure. So, first of all, this is a relationship business and development is a hyper local business. So we sourced this acquisition off market, direct with some folks who are local in the Kentucky market and active, and just really needed a more sophisticated development partner, help them with access to capital, and allowed us to really step in and do this project with them. And of course, now it's a strategic relationship that we formed with these gentlemen in Kentucky. And we're going to have repeat business here. We're going to have more and more of these opportunities. In fact, we already have a couple more coming after this one. So mitigation of risk is a couple of things. Number one, it's about ensuring that you have entitlement risk. And I know that I'm going to the last one on the slide here, but that is the first one, is entitlement risk. You want to make sure you get the entitlement risk off the table. So there's no environmental issues. There's no planning and zoning issues. There's no density issues. There's no wetlands, environmental, ecological issues with the property. And then we take it a step further to vet, and understand, what does that road layout look like? What are the road costs going to be? And is this actually a financially feasible project? We do all of that before we ever even consider taking in an investor's capital. We do that with our own dimes, our own money, and our own time, energy, and effort. So we remove that risk before we ever would allow our fund to invest or other folks to invest in a project. Now, jumping back to the forward purchase contract, that is the second step, and it's the most important one in addition to entitlement risk, because it's how you're going to exit the deal. And if you don't know how you're going to exit a deal and you can't secure that, that's a massive risk in these projects. So what we do is we get a forward purchase contract. That means that the home builder is giving us a contract, and more importantly, they're giving us a deposit that ranges anywhere from 10 to 20% of their purchase price, and it's used and released into the project as part of the capital in the project. So we've secured the buyer up front before we ever close on the land and take an investor capital. We've removed the entitlement risk, and now we just have an execution project with a fixed timeline. Like Eddie mentioned, it's a great suburb of Lexington, which is a very wealthy community in Kentucky. Lots of demand there. We've already sort of vetted the supply-demand economics, and it's just an absolutely great community. The forward purchase contract is with D.R. Horton, nation's largest home builder. So that is massive reduced counterparty risk. You always want to understand, what's the risk of the counterparty that I'm transacting with, and what's their capacity and ability to close, and where's their skin in the game. Well, they're giving us a big deposit. They're the nation's largest home builder. They got there for a reason, and it's because this is how they structure their deals, which allows room for us to leverage our horizontal land development practice. And then Also equally important to mitigating risk is the phased acquisition. That means that we don't have to develop the entire project at once and incur all of that expense up front and then wait for that to get paid off. We can build expense and build development costs in the project, and then they take down lots. So we're building expense and then we're reducing our liability. We're building a small amount of liability, reducing liability. And so by phasing that liability throughout the project, we are severely de-risking the entire project in the process.
Absolutely. So a little bit more about the location here. You can see Highway 60 and then 902. Both these major highways right here are, right here, it's kind of cut off in the map, but that's actually an on and off ramp from 60. And you can come right by this. There's 2 road frontages. We actually spoke with one of the development partners that are actually developing right behind this, just to think about, how interested they were in a project like this. And they, of course, wanted to know if they could have a piece of it right away. They definitely looked at it and they seen it as a benefit, because what you really can't tell from this map is down here towards the Simpson service, there's no direct access road frontage. They have to come through a bunch of roads to even find that property and where they're developing there in the brown space. So one of the questions that we ask is about absorption. And absorption, how fast are their lots being absorbed into the market? And because we knew their biggest challenges, you can't get direct access to where they are. So we know that we're going to actually put a spur, a right in, right out on Highway 60 and 902 here, to where we can have direct access to our community, which would greatly reduce our concerns with assumptions or with absorptions. So land purchase price, tractable basis at 7.8. Our Hampshire equity is 1.3 million. And you probably thought, well, wait a minute, we're only putting down 1.3, but the purchase price is 7.8. So hold your horses. We're going to get in that further in the next slide. We're going to explain how exactly that's going to work. Project cost is $25 million. Timeline is 24 to 30 months. And this particular one is speaking to about a 30% annualized return and about a 1.6 equity multiple. Again, the demographics of this area, very, very nice. We went into Lexington, we ate lunch. It's such a great place. The growth there is just unbelievable. So much money in horse farms and everything. It is such a great place. It's a growing market. So we're going to get into this. Shane's going to run us through kind of looking at how we're de-risking this and how we're not over leveraging.
Yeah, thanks, Eddie. So on the left there, you can see our sources and uses. And really, like Eddie pointed out, if you look towards the bottom of that, you can see the HC fund equity is $1.3 million, or just 5% of the capital stack. And that is critical in terms of how we structure risk, because we have a builder deposit that is 4.5 million. So the home builder, again, is putting skin in the game, and they're putting that capital down, and it's released into the construction budget and is actual capital that we can utilize for the horizontal development and construction of the project. And so that is a massive de-risk of the project just from that one trigger alone. Secondly, let's talk about the construction senior loan debt. On its surface, you would say, gosh, guys, that's 77%. That's kind of a risk in terms of a high leverage debt product, which seems counterintuitive to what you just explained relative to risk mitigation. Well, here's the beauty of how that works: is that the construction loan never, we kind of call that amount, but we never use it. So because of that phased acquisition process that I described on the prior slide, the max exposure on that loan product is going to be about 50% of that. So about, in this case, call it about 9.5 million. It is about the max exposure that we'll ever hit in that loan product, because as soon as we build to that exposure, we have a tranche of lots that close with the home builder, and then we get more equity, and we pay down that senior debt, and then we build it again by proceeding with the horizontal construction cost, and then we pay that liability down. And so after that initial first tranche of lots, that is our highest exposure, is that moment in time. From then on, through the rest of the project, we continue to diminish our exposure. And that is, a massive de-risk in the project in terms of how we're utilizing leverage and capital.
Absolutely. And a pro tip, So if you're looking at any deals like this and you're looking at sources and uses and numbers, I'm gonna point something out you should always see in there, and that's a contingency. If you're looking at projects other than ours and you don't see this number in there, you need to ask the question. So another question that you would ask your sponsor, your fund manager, is what is your contingency number? Because contingency means we have money set aside for when things go wrong. And guess what? They always do. We find something that we have to drill and blast, more rock. There's always something in construction that just doesn't go right. So we just plan for things not to go right, and we just put a bucket of money off the side. And we
Yeah.
don't have to use it. It's great. When we do, we're glad we put it aside.
Eddie, I'm gonna share one of my favorite sayings from our lender. The next project that we have that's on time and on budget will be the first.
That is so true. Absolutely true. So the next one we've got here in the pipeline is a very exciting project. And this one's a little bit different. And Shane will talk about how we de-risk this one in just a second. But this one here is a build to rent community. It's in Crestview, Florida. Again, it's another one of these underserved markets, extremely exciting, close to the coast. And there's just so many good things happening here. And we've got tons of, you know, checking the boxes off by Nick and Michael going out and talking to other property management companies that are managing communities in this area, understanding the really key details on these projects. And we know that when we deliver this one, we're going to be the only one in that time frame delivering a new supply of exciting new units for people to rent. So this one here is a mix of townhomes and single family residence. It's 188 townhomes and 70 single family, which again, we went out and we checked the data. We looked at the micro data, the area, and then we physically went out to the people that manage this product and said, is this true? And we got that confirmation. So again, this was sourced off of a off-market acquisition through Hampshire Capital's efforts. And we got a vertical integration here, and it's an underserved growth market. So Shane's going to explain how this one's a little bit different because this is a fee build. So we still de-risk, but it's done a different way.
Yeah, that's right, Eddie. So, we're a vertically integrated developer in that we source the deal. We got all the entitlement risk out of the way. We have reduced the horizontal construction risk because we bid that out to, 3 or 4 different horizontal folks. And we asked around about, in the area, who are the right contractors. And this particular company that we selected came up as one of the top 3 in every single discussion. And so we know that we have a great horizontal construction partner there. That risk has been removed. And then, like Eddie said, we're able to get a price point and a price per square foot on the vertical by partnering with a top 25 regional or national home builder that just has the buying capacity that we can't fathom. And so we're leveraging that, and they're building the homes, and then we're just buying them back or taking them at C of O or certificate of occupancy when it's completed. And again, massively de-risking the process by having a home builder just own the entire process from foundation to finish. So we're not managing, 32 different subs for every single building or every single home that's being built. We just have one counterparty risk, and that they're an A credit counterparty risk in that process. And that is absolutely key to this vertical integration of developing a BTR community to own with our institutional capital.
Absolutely. So this is the investment profile here on this particular project. Again, you can see the difference between your construction senior loan and your common equity, and then your LP equity investment, and then your HC fund investment. So Shane, explain that a little bit on the differences here between the two.
Yeah. So again, we're able to get equity solved, the largest chunk of equity from a very large equity group that's going to come in for 90% of the equity, or in this case, just over 14 million, which leaves us with only having to come up with about 1.5 million in equity for this transaction. Now, it's not a typical LP GP relationship. We're doing this as co-GP equity, which means that all equity is pari passu or on the same plane. So when they get a 10% return, we get a 10% return. When they get, a 15%, we get a 15%, on and on. So the equity is treated the same. We just solve 90% of it with them and 10% of it with our own fund and capital.
Absolutely. And this one here, it's 31% on the IRR, and it's a 2x equity multiple. So, Mo, you've done a ton of research here. You are one of the key parts here to find this particular project. So, if you'll speak on, what was really the drivers, what made this exciting for Hampshire Capital?
Thanks again, Eddie. In addition to return of capital, we really think about land development and investment opportunities through really kind of focusing on locally based residential solutions. So specific to here, we're talking about, component of the panhandle area, right? And so, risk mitigation has been brought up. We also think about mitigating risk through strong collaboration and communication with local municipality decision makers. And this area tend to be developer friendly, if you will. So that was another key component. But drilling down on kind of the housing demand, I mean, in this pocket, there's a tremendous opportunity to deliver really affordable housing, right? A lot of the focus was kind of more on the coastal areas, and we saw a tremendous need in terms of the inland locations to deliver the housing needs for folks working at the Elgin Air Force Base, the new Shoal River Ranch employment driver that's coming to the area. So we thought through addressing housing pressure for new supply and attainable rental, this opportunity helps really solve both those areas.
Absolutely.
Yeah, I'll also add, and this, Crestview, Florida it's a bit of an enigma in the sense that it is a smaller market, call it 30,000 people living there, but it is growing very rapidly. Like most of the Sunbelt markets, it hasn't been immune from new construction over the last 24 months. But as Eddie mentioned earlier, a lot of that product is currently finished and then leased up in the market and is all expected to stabilize kind of the middle of next year. We're not delivering our first units until Q3 of next year, so our timing is fantastic here. And speaking to the commercial brokers working in the market, they've said that Crestview, and they're working all throughout the Southeast, Crestview, the deals they've been tracking and working on in Crestview have had the strongest absorption they've seen in all of the Southeast. So it's a very interesting growth market. There's a lot of demand for housing. There's only recently been a influx of new housing, and it's just been very well received. And with the growth factors of what's happening with the Air Force Base, the cost pressures of the coastal markets in the panhandle of Florida, and with this new Shoals River project that Mo mentioned, there's just a lot of positive momentum in this particular market.
Absolutely. Thanks, Nick. Again, on the location summary here, it's super strong. I'm not going to spend a ton of time on this slide, but, we got 34 acres here. It's on Lloyd Street, which is a great mainstream road. We've got really big brands that's close to us, and that's just a few of them we picked. So we got a really strong median household income, and your median household value, which we'll get into a little bit more here, I just want to outline, is $349,000. And Nick will talk on this next slide. Let's go over this real quick, and then we're going to get into really what that 349,000 means on another slide. So Nick, take us through this part first.
Yeah, sure. Glad to, Eddie. So, we've got a total project cost here of about $57.5 million, which comes out to about a $224,000 per unit development cost. That is a very attractive price per unit on a development basis for this market. Typically, what you're seeing for product here is delivering between kind of $240,000 and $250,000 per unit. So we've got a interesting advantage there to the market, and that's really relating to two factors. One of which is we have got a very attractive land basis in this project, and also the creative construction structure that we've come up with here has really helped drive down the hard cost of the project, which is allowing us to deliver this property and develop this property at a very attractive cost basis, which helps drive the returns and make this a very appealing investment.
Just a little bit more on the projections here. Nick, if you want to hone in on kind of the stabilized and then how we're trending this out.
Sure. Yeah, I'm not going to get into the weeds on this, but happy to dig in any details if anyone wants to review it and have a follow-up conversation. So, this is a 5-year pro forma. Years 1 and 2 are really the lease-up period, and that year 3 is what we're projecting as our stabilized year. And I would encourage you to look at that return on cost number at the bottom of the screen. And anytime you're looking at whether it's a new construction deal or even a value add deal, really return on cost or yield on cost is really probably the most important metric you want to pay attention to, because it really is the metric that demonstrates value creation. And what that return on cost or yield on cost is essentially a forward cap rate. And so cap rates are how commercial real estate is valued, and that's essentially the project's operating income divided by what someone is willing to pay for the property. And so in the context of return on cost here on a forward basis, what we're saying is that we're taking that year 3 net operating income of roughly 4.5 million. And if we divide that by our cost basis, the attractive cost basis of 57.5 million, we're getting a 7.7 return on cost. Now, the market cap rate here is more like today, 575 to a 6% cap rate. And so if our forward cap rate or forward yield on cost is greater than the market cap rate, someone is going to pay a 5.75 or a 6 cap for the property, but we've created value at north of 7.5 here. So we've got 150 basis point spread between what the market's willing to pay for something and what we're actually delivering it for. And so that spread is your value creation. And again, whether that's in new construction development or a value add project, you want to see at least 100 basis point, ideally 150 basis points spread between kind of where the market cap rate is and where your yield on cost or return on cost metric is at stabilization.
So here's a little bit more on the timeline of this. So the fund investment returns, again, this one here is speaking to about a 25% average annualized return. It's a 3-year hold, and we are stabilizing this thing out in 2028. And you can see our timelines here. We're not over leveraging. We're looking at the closing in December, and then which that's actually pushed just a little bit, but we're really close to all of these. And then our construction starting in January, and then your vertical construction starting in May, and then our lease up is actually October, and then construction completing in 26. So kind of back to Nick's numbers there. If you think about that, we're actually leasing this thing up in 18 months, and we're moving this in and getting it stabilized before the construction's even completed.
Yeah, and that 18-month lease up duration was vetted and confirmed by 2 independent third-party property managers Michael and I have been talking to about the asset. So we feel like that's that's what they're seeing in this current market for lease up, with a whole lot more of supply pressure and competition. And so we feel pretty good about an 18-month lease up schedule on the backside of all that supply pressure in this market.
So as promised, time for Q&A. Anybody that has questions, I'll make sure everybody can talk right now.
Hey, Eddie, I want to bring something up because I think it's really, really critical. And I want to make sure that everybody on the call truly understands this concept. When we're talking about returns on these deals, so we have a horizontal land development deal that has a 30% annual return. And we have a BTR deal that's a 25% annual return. Now, the key important thing to note is that these are not projections. This is not, well, if this happens, then you'll get that. If the waterfall goes a certain way, if we hit this, these are preferred returns. What do we mean by that? On the horizontal land development, you're getting your principal back plus a 30% annualized return before the developers or before the general sponsors can get a dime. You're putting the investors forward. On the BTR deal, you're getting your money back plus a 25% return before the general partnership can get a dime. That's a very investor forward thought process relative to how we structured the total return comp for the investors, and in this case, obviously for the fund. So it's important to note that these are preferred returns. They're not speculative waterfall returns.
So let's just think about that for a minute. So let's say someone invests $100,000. So let's just do Crestview for an example. So $100,000, and that's 25% average annualized. So that means over the 3 years that's $75,000 in returns. And
Correct.
then you're getting your principal back. So we're going to return them. You invested 100, we return you with 175. And
Sure.
man, if you think about passive income, which let's explain passive income real quick. So, passive income is not active income. Active income is where you physically have to trade hours for dollars to make that money. In passive income, you're taking your earned income and you're investing it in something else and giving you that additional passive income stream, which everybody talks about additional streams of income. This is how that's achieved, by making that investment, earning $25,000 per year for 3 years, and being returned with that in total capital And it just gets better by the more you can actually invest in this project. So if anybody doesn't have any questions, we'll keep moving. I want you guys to know if you need anything, these slides, if you need the underwriting, we encourage you to ask us for them. Brendan here, I'm sure, has answered a lot of questions. He's probably put our investor portal in there. If you have anything you want to learn more about, jump on a private call. Just, talk about this. We encourage that. So please reach out to Brendan, book a call with him, talk to any of us. We're here as a resource for you. We know that for a fact that this project will be closing soon, meaning here in a very short period of time, we're going to be oversubscribed and we can't take any more investors on this style of project. So please, by all means, make sure that you reach out right away. I know it's around the holidays, but I want to raise the urgency. I also want to say that not every investment is right for you, and this one may not be. And I want you to think about this. Maybe this isn't the right investment. I wouldn't want you to miss out on this, but the timing may not be right for you. So please, by all means, if it is right for you, don't waste any time. Reach out to Brendan today.
Thanks, Eddie. Yeah, guys, I have my link right there in the chat. We'd be honored to jump on a one-on-one call with you guys and answer any questions that you guys have directly.
We thank you all very much for your time. The QR here can be scanned and go straight to our investor portfolio, straight into our InvestNext platform. One thing I want to touch on is investor relations. So Michael and Brendan both collaborate often, and they draft investor reports that goes out all the time, and we communicate. Even when it's bad news, we communicate it, and we do it well. And I want to make sure that everybody knows that we spend a great deal of time caring about not only your first investment, but your last one, and even your friends investing too. Thank you all, and have a great day.